Welcome everybody. I hope you can see the small PPT that I have shared on the screen. So welcome to the session. We are discussing negotiating tax indemnities in India. I think tax indemnities, as most of you are already aware, are heavily negotiated. They have become a very important part of documents today where tax is really involved. And considering the aggressive nature of the tax authorities in India, a tax indemnity in a document becomes really, really relevant. I'm going to stop there and directly move to what we are here to talk about and go to Rajesh to give his thoughts on this topic and what he feels is going to be the future of tax indemnities in India and how is it all looked at.
Thanks, Ashish. I think whenever we are sort of looking at any M&A or PE transaction, obviously, and I think sometimes I do think a bit too much time gets spent on tax indemnities than what it should be. But a lot of that comes in from the fact that there are no clear market standards. How people look at tax indemnities in India is probably slightly different from how you look at it as a global standard, which is there in terms of when you look at global deals and the kind of warranties or indemnities that get negotiated on the tax aspect also is slightly probably different from what you actually see in India. A lot of this stems in from the fact that and Ashish did allude to one of it, one being that the Indian tax authorities or some of the tax positions in India, you don't necessarily get certainty all the time. There is a lot of back and forth with the tax authorities. The quantum of tax litigation in India is tremendous as compared to what you see in most other jurisdictions. The extended time limitation which tax authorities have in India is not generally found in most other jurisdictions. And lastly, I should also mention the kind of transfer pricing litigation that we see in India. So all of this sort of stems in and has a role to play in terms of how tax indemnities actually get negotiated or drawn up in India, which is slightly different from, as I said, what you would see elsewhere. And again, even as we sort of go forward, and each year when I see the budget and I see new provisions, whether in terms of limitation or giving extended power to the tax authorities, you just tend to think that, okay, it's not like we are going to have situations where the kind of adversarial sort of nature of disputes in India is going to reduce, and that obviously is going to have an impact insofar as tax indemnities is concerned. So let me just pause there. Ashish, back to you in terms of taking it.
Sure. Thanks, Rajesh. I think I'll go to Parul right here and take our perspective also on the topic and what does she think about it, maybe more from a PE investment and portfolio company perspective.
Yeah, sure. Thanks, Ashish. Tax indemnity is really critical in any deal. And, based on our past experience, when we have helped private equity investors, buy a company or in any M&A transaction, it can also become a deal breaker. Now, the reason tax indemnity is also important is because the pricing for the company gets also negotiated based on the tax amount and the tax indemnity. And to just give an example, if a private equity investor is buying shares of a company and taking control over that company, there are certain assumptions which are made from a tax perspective, which then gets added onto the pricing gets determined from that perspective. But if those assumptions are not found to be true, or if the tax positions which are taken in the portfolio company's tax returns are very aggressive or they are not correct, then it can just spoil the entire Excel calculations which have been done by the private equity investor. It can just make the IRR calculation just go for a toss. So we've seen that tax indemnity, and while there are other legal indemnities also, but specifically for tax indemnities, considering that the Indian Income Tax Act is not really the most simplest one in the entire world. And given the, changes that keep on happening year-on-year basis, we've also had, changes happening to our accounting standards, which have had corresponding changes to the tax rules also, given the NDA and the MAT issues which come up. And different tax positions are taken with respect to, calculation of MAT, with respect to calculation of depreciation, specifically for infra companies. Is your tax holiday claim correct or not? So we've seen a lot of DD issues, due diligence issues getting triggered because of these concerns, and the role of tax indemnities is just, taking a lot of importance in the deal negotiations. Over to you, Ashish.
Thanks, Parul. So I think while both of you have covered a little bit about what the importance of tax indemnity is today, I think let's dig a little deeper into how relevant are these from a document perspective, from the perspective of having separate clauses, and is there any alternative available today? So I think I'll go first to Rajesh on this and take his viewpoint on the relevance of tax indemnities in deal negotiations, and what does he think about where we are going and how we should be looking at it.
So I think there are two parts to this, right? The first one is that, and again, a lot of what I would call, whenever we are talking about deals and when we are speaking about having separate sections running into pages and pages on tax indemnities, I think one of the first questions which and I think everyone needs to ask that is that, do I really need to have a separate section on tax indemnities? Why can't I just put that as part of third-party claim bucket? Because usually in any transaction document, whether it's on an M&A or whether it is on a PE investment, you have two different buckets which are there, one about direct claims and one about third-party claims. Anything relating to taxes is usually something which you would look at as a third-party claim. So under those circumstances, do you really need to have a separate section just to deal with tax indemnities, or can't it be rolled over into the third-party claim bucket? Again, from a approach standpoint, again, my view has been that if you're able to draft it in, you can do it as part of a third-party claim bucket. But the reason why a lot of people end up trying to have a separate section insofar as tax indemnity is concerned is, one, around the nature of the process and the nature of the litigation which happens. So there are a lot more specificity which gets built in as part of a tax indemnity, because people are a lot more worried about things like interim payments in terms of conduct of proceedings, because it can have a bit more overarching impact. Because think about it from the perspective that tax indemnity can cover two possible scenarios. One scenario where you're talking about the warranties relating to the business, and you're talking about the tax warranties, or the second one is in relation to the actual sale of shares, where there is a withholding tax or a rep SSE or a issue. And for both of these, you are trying to put that into the tax indemnity bucket. But in both of these scenarios, the challenge which is there is that when we are thinking about it from the business tax warranties perspective, any assessment can have multiple different issues and can have ramifications across multiple different years, which are going to happen. So you do always tend to be careful saying that let me just devote a separate section for that. The second one is that when it comes in insofar as withholding taxes and rep SSE are concerned, there again, it is not a liability which is linked to the portfolio company, but actually linked to the seller. So you end up having it as a separate bucket. So again, the tendency has been more to have it as a separate section, much more than just weave it into a third-party claim. So I think that's where I see it going towards. The other point which I will stress on is that when we are talking about tax indemnities, that's only one mode in respect of what is it called, recoveries, right? Because usually, depending on who the seller is, you just go in and get in a tax indemnity. But there are obviously various other alternatives to tax indemnities, whether it is getting a tax insurance, whether it can be getting a certificate from the tax authorities for nil withholding, whether under 197 or under Section 195 of the Income Tax Act. You have other alternatives such as a escrow or a holdback arrangement, apart from possibly going in for AAR rulings. I think the one key aspect is that what you will end up seeing a lot more on global deals is where people think more about escrow and holdback. Whereas on specific India deals, you look at more around tax insurance or a certificate of 195, 197, or you go in towards the AR ruling, which is sort of subsided quite a bit over the last few years. Unfortunately, the AAR has not been functioning too great, and on top of that, the rulings which are coming out from there are not really well-reasoned orders. So it's sort of a mix and match where people try and say that, okay, let's get comfort on the tax indemnity insurance. There is a cost to the insurance. I think currently the market is at around 5% to 6% as premium on the insured amount. So there is a cost that is associated with tax insurance, and they are slightly choosy in terms of what deals they are underwriting at this point in time. And choice around the 197, 195, again, people loathe approaching the tax authorities for this because the tax authorities look at just protecting the revenue's interest. And usually 195 and 197 certificates only are tentative certificates, so still subject to final assessment, or so that's not again a path which most people follow. So to a large extent on India deals, you find people sort of managing between getting tax indemnity and tax insurance. On global deals, on the other hand, the escrow and holdback is much more prevalent from two different perspectives. One, escrow holdback arrangements in India, you are subject to the FEMA restriction on 18 months and 25% cap, which is not there when you're looking at a global deal. The second thing is that usually the tenure of indemnities are slightly lower, and also especially when you have multiple different sellers who are involved. The global standard is that people do like the concept of escrow and holdback as compared to what happens in India. I think that's what I see from a global standard. So Ashish, just my thoughts going back to you.
Sure. Parul, I think we'll take your thoughts and then maybe I'll conclude something on whatever you guys are saying.
Sure. Yeah. No, I think Rajesh has explained it quite well. Just a couple of things that I've seen based on practical experience working on M&A deals. One that usually the tax warranties, the tax indemnities, and the general indemnity is also one of the reasons why they're segregated into different buckets, is because for the tax indemnity part, there is a different method for calculation of the indemnity, and also the number of years for which the indemnity runs. And of course, I know, Ashish, you're going to talk about that in the later slides, so I won't really, jump the gun here. But that's one of the reasons why it's just easier from a documentation perspective to segregate the two, so that you can easily lay out the differentiation in the time periods and the amount and the cap of the indemnities. The other thing that we have seen purely based on practical experience is that, when we talk about an alternate to tax indemnity, and more so in the context of, the deals where shares of an Indian entity are sold and where there is a tax treaty benefit available, many times we have seen that this ends up being a negotiation between the buyer and the seller. And it really depends on, who's really more keen to do the deal, and both of them are keen to do the deal, then, they both will take a step forward and come to an acceptable solution. One of the reasons why the certificate under Section 195 or 197 is not preferred many times is because, from the seller's perspective, the seller does not really want to put forth his entire structure to the tax authorities, no matter how kosher the structure is, and no matter, that there is appropriate substance and tax advisors have signed up on the structure, they don't really want to go to tax authorities and, really open up their files for them to see. Although we have seen tax authorities are or have been giving, clearances and not really nil withholding tax certificates, but at least in, I'm based in Delhi, so I've seen in Delhi they have given a 1% TDS rate, and, no one really knows how that 1% rate is arrived at. But they have been looking at that. Of course, it's a matter of time frame also, how much time we have to close the deal, and it's not something which is recommended upfront, because then it also becomes a personal prerogative of the tax officer, as to how he really sees the structure. So that's one, that's the other thing that we have seen. The third thing we have seen where holdbacks are concerned is that many times when Indian promoters are concerned, and also depending on the sector, and we've also seen that, while we've done due diligences, that many times clean orders have been issued by tax authorities, whereas the discrepancy in the correct tax treatment is clearly, shown on the face of the tax return. And in that case, no private equity investor really wants to take the risk of, reopening of an assessment at a later date. And given if they're really dealing with, depending on who they are dealing with, at times with certain Indian promoters, they don't really feel comfortable in just living with the tax indemnity, but they would prefer to, to apply some sort of a holdback, which of course is never preferred from a promoter perspective, and from a deal perspective, you want to close the deal, but that's also something that we have seen practical. So it's a mixed match of many things, and one can't, really say that, the right approach is a tax indemnity, or it's a holdback, or it's a 197. Each deal is different, and so each, method of dealing with the tax issues is also different.
Yeah, I think the one point I would add just on that, and when Parul was mentioning about, sometimes with Indian promoters, you do want to have a escrow or a holdback structure. And even in those situations that we end up seeing, right, you end up having that for 18 months, especially when there is some imminent, if there is a business tax warranty, or there are imminent sort of assessments which are ongoing. And you do want to be on the prudent side at that point in time, where you do want to create the escrow. Obviously, the indemnity will still go in for a longer period, but you just want to layer that up with having that escrow mechanism also. I think that's something that tends to happen. So sorry, go ahead, Ashish.
I think a couple of points that I'd like to make here is that, as a tax lawyer, and I think both of you will also agree that we find tax indemnity should have a very special place in an agreement, and seeing them be put together with the general indemnity or with a third party indemnity somehow does not make too much sense, considering all these procedures, the conduct of the proceedings, the time limit, the amounts that are involved with the tax indemnity. I think many of those reasons also are to be put forth, while deciding whether we can include a tax indemnity or not. The other thing that I'd like to touch upon very quickly is on tax insurance, and that is tying in with the aggressive positions that tax authorities are taking today. Now, while Rajesh, you said that tax insurance is becoming more favorable, and people want to look at tax insurance also as an alternative, but considering the tax positions that the authorities are taking, do you think tax insurance is still going to remain, or do you think that tax insurers are going to become more not aggressive, basically, in their way of working?
Sure. So I'll just give you first the insurer's perspective, having worked with pretty much most of the insurers on the street. From an insurer standpoint of view, I think what we are seeing is that there is increasing competition. So that's one thing which is actually acting in favor of more policies being issued. Earlier, it was actually a pretty small market But now you have a multitude of insurers who are willing to look at this particular risk. So that sort of ensures that it broadens the depth in the market. So that's a good thing going in favor of it. The second thing, having said that, is that there have been concerns which have been expressed over the last 6 to 8 months around a couple of different judgments which have come in from the AAR. One is the AB2 judgment, and then there was another recent judgment also where questions have been raised around treaty eligibility. So that has sort of ensured that insurers are also treating the matter with a bit more care. So they do want to do a lot more in-depth sort of work before they go ahead and underwrite. The third bit is that where there are certain matters where you have, let's say, there have been previous transactions which have been made by the fund or the entity, and those assessments are under scrutiny at this point in time. Under those circumstances, you know what, if there are live proceedings already underway, and then you go in for a tax insurance, that again makes it slightly tricky. But the fact of the matter is that today there is a market which is there. There's a market which is available. The premiums have actually having said that, and I do see that going on for the next, at least for the rest of the year. But having said that, again, it is not a case that all deals get underwritten, or all deals which are given to insurers get underwritten. There is a high number of failures also in terms of insurers passing on and not wanting to underwrite certain kinds of risks.
Sure, thanks, Rajesh. I think before we move on to our next section, and question to Parul first, and then perhaps to Rajesh. So, Parul, in your experience, since we are discussing role of tax indemnities, have you seen instances where there has actually been an invocation of the parties?
So, in my experience, I've not really seen an actual invocation by the parties, but maybe it's not happened in my cases, and Rajesh can add on to his experience. But what I have seen is in one of the cases where, the case got picked up by tax authorities, and the insurance company, they had insured the claim, and, we are seeing how the invocation is happening between the insurance company and the parties to the insurance. And, it's actually a very interesting manner in which this is happening, because now suddenly everyone is tooth-combing the insurance contract to see whose liability it is to pay. And what you really realize then, and specifically from a tax insurance perspective, is that the insurance is as good as the papers which are provided to the insurance company. And no matter how the reps are built into the insurance or not, ultimately, if there is a claim by the tax authorities, and that claim is, that claim in this particular case is currently under litigation, but ultimately, if the claim does fructify, then, I think that's going to be one of its kind. Specifically because of that case, we did see that particular insurance company going slow on tax insurance in India. And that's at least one of the cases where I have seen, and it's not really a smooth conversation to have between the parties.
Yeah, and at least from my experience, I'm actually doing a couple of live disputes around it, which are quite interesting in terms of where we are claiming on both claiming and defending both in respect of various tax warranties which are there. So and also in the past, we have seen situations where the indemnities have been invoked. Usually what tends to happen, right, is that the discussion more than anything else is around the payment of the counsel fees or the advisor's fees and the interim payments, right? Because the fact of the matter is that tax disputes in India take a extremely long time to get settled, because you do have to go through multiple layers of appeals and challenge. But we have seen situations where the party which is provided the indemnity has been picking up the tab around the costs and expenses and also for any interim payments. The other thing which is also interesting is that have also seen situations where there are indemnity claims which are outstanding because there are proceedings currently which are underway, and the parties are actually sitting and discussing whether they should opt for the tax settlement scheme which has been recently issued, right? So there is a lot of discussion that happens even around that, because obviously it's always a bit of a mix and match, right? Because if you go in for settlement, you only have to pay the tax and not the interest and penalties. Vis-a-vis that, do you then go in and take fight it out and take the risk of the downside, which is that the interest clock keeps ticking and potential penalties. So that's also something that's quite interesting, where on deals we have seen situations where people are sort of deliberating around a settlement structure to take care of the indemnity. The depreciation of the dollar has actually helped in sort of reducing the depreciation of the rupee, my apologies, has helped in actually reducing the overall quantum in most of these cases. So that's actually helped in sort of smoothing out some of these discussions.
Sure, thanks, Rajesh. It was a very interesting thing that you heard about. I think we'll move on to our next section, which is basically some other considerations that are required in a tax indemnity. Now, Parul, your perspective on the scope of a tax warranty and how the calculation of that indemnity should take place. What do you think, and your thoughts there?
Yeah, sure. So I think, Ashish, when we talk about scope of taxes, it again depends on what we are trying to cover in indemnity. Are we talking about the taxes at the company level, and that company is being purchased by a private equity investor on an M&A transaction, or are we talking about a transaction of sale of shares? If it is a transaction of sale of shares, then the question that really comes up is how do you really calculate the tax? And when you calculate the tax, what is the characterization of their income? I think mostly for private equity transactions, it's quite clear that it should be capital gain income, and usually that controversy doesn't arise. But we have still seen practically that people do, put in the one-off situation where tax authorities can claim it to be a business income, specifically since they do have a power under one of the circulars. The second issue that comes up is there, is there going to be a MAT liability for the capital gains tax? And again, that again depends on, who the investor is and what the transaction really is. But that's another thing that we have seen. And the third is also the actual calculation of the tax. And calculation of capital gains tax in itself is complicated, as one would expect under the Income Tax Act. And there are different rules for calculating capital gains taxes, and the parties really have to come to an agreement, which practically we've seen, more or less advisors do, each set has their own set of advisors, and they do come to an agreement on what should be the correct methodology for calculating the capital gains tax. And once there is an agreement on the capital gains tax liability, then, there is an interest component, there's a penalty component which gets added on. Many times, for indemnities, there could also be other direct tax costs that get added on. For example, Rajesh talked about counsel fees. Usually, indirect losses are not covered. For example, any loss of reputation or any loss of business because you're dragged into a tax litigation. And what's really important is that the treatment of taxes for a person who's withholding or who's required to withhold under law and the person who's selling the shares is different. And just to give an example, if there's a purchaser of shares of an Indian company, then the penalty for the purchaser is 100% of the tax amount. But if it's a seller, and more so, the tax indemnity is going to be for the purchaser only, because if the seller has to pay the tax, that's the seller's tax liability, unless and until we're talking about a contract for tax insurance. So one has to be cognizant of the penalty that actually could apply to a buyer, the interest rate that applies, and the tax amount. Do the calculation, and that's generally how the tax indemnity amount is arrived at when one talks about, the scope of the taxes. I'll just pause here. I'm not going into the different, method of calculation when we're talking about taxes at the company level, but basically the scope of the taxes would be, that's how we have seen it happening practically.
Thanks, Parul. So Rajesh, your take on a couple of points on this aspect. One, in your experience, whether you have seen other costs to be covered or not, and do you think these costs can be unlimited? Point one. And point two, from a withholding tax perspective on indemnities, do you think that should be covered in the document that we negotiate, or do you think we can leave that apart and see it when the indemnity actually is invoked?
Sure. So let me take up the cost point, right? And that sort of weaves into the overall cap when you're thinking about it, saying that if I'm having a tax indemnity, what should be the limitation which is there? And the market has sort of evolved, and I'm using market here loosely because it's not an absolute situation, where at one point you had a situation where people were looking at a potential 3x coverage, which is essentially 1x for tax, around 0.84x for interest, 1x for penalties, and the rest sort of putting it into costs. As a general thumb rule, yes, costs are included as part of your overall cap. I think the question really comes into how are you actually negotiating caps? Because you had 3x, which was a standard at one point in time. It came down. I've seen everything going in from 1.3x to 3x. So I've seen 1.3, I've seen 2x, I've seen 2.5, depending on what kind of permutations and combinations that you sort of build in. And a lot of this is obviously driven by who has the better hand in terms of negotiation. But having said that, again, are there situations? Let me start off from the basics. Are there situations where things are unlimited? The answer to that is usually no. We do try to limit it, and again, looking for tax indemnity is comfortable sort of limiting the liability to a certain cap. Do we see 3x in all deals? The answer is no, not really. We do see things sort of ranging between, probably now it's more common to see 2x to 2.5x more than anything else as indemnity cap, but yes, costs are always included. The second point that you're talking about is the gross up of taxes, or should I cover myself for the indemnity payment? Should I gross up for any taxes which may potentially apply in respect of the indemnity payment in the first place? I think usually the first point, and I would always stress upon this, is that indemnity payment as such should be regarded as a capital receipt in the first place and should not be chargeable to tax. There are precedents around this. Unfortunately, nothing that has been so direct, but we have argued such cases where successfully where we have argued that payment of damages or payment of compensation for loss on the value of the shares should be treated as capital receipts, which has been upheld by the AAR. So in those kind of situations, normally the indemnity here is always linked to the acquisition of shares. And therefore, all of this should be treated as a capital receipt and should not be actually chargeable to tax in the first place. So, but having said that, again, as a buyer, I would not be sitting there and saying that, listen, I'm going to take this headache because if I have suffered a loss of 100 rupees, I do expect to be made good for the whole of the 100. So even if there is any tax in respect of the indemnity, I would expect that also to be covered. Though usually what we try to do as part of the documentation also, and something that you see a lot more, again, global deals, it's very common. India deals more and more is frequently used, where you say that any indemnity payment should be treated as an adjustment to the purchase price of the shares, therefore making it explicit that the intent of the parties was to treat this indemnity as an adjustment to the purchase price, which again sort of betters your argument around treating it as a capital receipt. I think the last point, because I do see a question around the gross of tax clause specifically, in terms of whether insurance companies are forthcoming in insuring such gross of tax arrangements. The answer to that is that it is negotiated. The starting point for most insurance companies is that no, we do not really want to insure a gross of tax provision. Having said that, in certain cases, have seen the insurers agreeing. Maybe the premium may increase slightly around it, but again, the starting point again in most deals is that no, we are not going to cover that. The insurance is only for the tax in respect of usually the capital gains tax liability, or if there is if it's a R&W insurance in respect of the business tax warranties of the company, but not necessarily to cover the withholding tax or any tax on the indemnity payments as such. Interestingly enough, and the last point I will make is that in some jurisdictions, apart from the fact that you're thinking about saying that in India, okay, it's going to be capital receipt and not taxable, in certain jurisdictions, the indemnity payment is subject to a GST or a VAT depending on the jurisdiction, which actually increases the cost. That also sometimes becomes an interesting question. But again, let me pause there, Ashish. Back to you.
Sure, thanks, Rajesh. On costs and what is the total liability that we are seeing in the market. But I think the other question that becomes also very important, and perhaps the thing that I am most bogged with is there a magic number to this? Should it be 4 years, 7 years, 16 years? I mean, I constantly get drafts which have all of these numbers, and a negotiation needs to take place as to what is the number for the determination of the period of claim. Now, I mean, I have seen 4 years, 7 years, all of it in my limited experience with these documents. Parul, is there do you have answered that magic number? What are the practical considerations we need to look at when for determination of the claim of period?
Right. So one, when we talk about determination of the period of claim, I think this is two parts. One is, are we talking about the period of the claim, or are we talking about the period within which a notice needs to be issued by the tax authorities? And usually it's the latter. And, under the provisions of the Income Tax Act, the tax authorities can go back 7 years to open up an assessment on the basis that income has escaped assessment. And so if they think that, income has not been taxed, then by going back 7 years, they can open up, and within that 7 years, then, they can issue a notice, either requiring the entity to file a tax return if it's not filed a tax return, or to start the assessment proceedings. And so therefore, usually, and mostly given the way in which the tax authorities have been functioning, specifically with respect to sale of share indemnities, the 7 years is most common. A word of caution there, when we talk about a buyer, and usually the indemnity is relevant for the buyer because it's the buyer who's making the payment of the purchase price. And the buyer would ideally want to withhold the taxes in order to be absolved of, any tax dispute in the future. There is a statutory time limit of 7 years, even for a buyer, but only when payment is being made by the buyer to an Indian resident. And tax authorities cannot issue a notice after this period of 7 years. However, if the buyer is making a payment to a non-resident, then in that case, there is no statutory time limit, although, there are arguments to say that if there's a 7-year period for initiating assessment on a seller, as well as for initiating assessment on a buyer for payments made to a resident, then the same time period needs to be, kept in mind. And usually it's a 7-year time period, which is then, built into contracts. And we've seen practically that's what's acceptable by both the parties, because in any transaction, having an unlimited time period for a tax indemnity is not going to be acceptable. I mean, we're talking about private equity funds, we're talking about, transactions which, where everyone is calculating their IRRs. This can never be open-ended. So 7 years is mostly acceptable. The reason why the 16 years comes into play is because, in case of indirect transfers, and I'm talking loosely when I say indirect transfers, because actually the provision talks about, any, in the sense of any offshore transaction, even where the asset is not based in India. In that case, tax authorities can actually go up to 16 years for making a claim. And we are seeing that people are, starting to say that for indirect transfer situations where indemnity is being negotiated, then a 16-year period should be put in place. But that's quite impractical, also given that mostly if you're talking about private equity funds, their life would be 8 plus 2 plus 2 at the most. So 7 years is most common. In a number of cases where we are dealing with indemnities which are, for the taxes which need to be paid by the Indian company, and, considering, that an Indian company's return would be, we had a very practical experience and it was an issue of, of a MAT position that was taken in the starting of the year when the company transitioned into MAT, and it was the question of calculation of the transition amount. And this is something which does not repeat on a year-on-year basis. So if the tax authorities have typically accepted it in the first year when the company moved into transition, then something really material needs to happen for them to really go back many years and try to tax the transition amount by claiming it to be much higher. In those type of situations, we have seen that the indemnity period has been lesser. And in fact, in that case, that particular case, the investor was also comfortable with, with a 2-year period on, looking at the time period within which the assessment needs to be done, or a notice needs to be issued for the current year, given the fact that the prior year assessment was already over. So again, it's a mixed bag approach. I think just one more point on tax indemnities, which is that usually, if there is a tax indemnity between two non-residents, then it is also much easier to, to negotiate and discuss. But if the tax indemnity, one of the parties to the indemnity involves an Indian resident, then to make a payment of indemnity from India will need an RBI approval. And that's also one of the reasons why many times holdback could also be considered. And, rather than really going with an indemnity. I know, Ashish, this is not linked to your point of period of claim, but I just thought I'll just bring that up as well.
Sure, Parul. That's an interesting perspective. So, Rajesh, I have this one very quick, I think it's a case study if I put it that way, but one very quick practical issue that I have come up with recently, and maybe you can perhaps give me an answer to that. Now, in a situation where there has been a document. The document has given a 7-year claim period, but in the second year, the assessment takes place. The transaction is opened up. The tax authorities give a nil demand, and the matter is over. Now, in your experience, do you think we should go back and renegotiate the document to say that the limitation period now is over and it should go back to 4 years? Because of these various points that Parul put up, right? That the shelf life, that the life of a private equity fund is, not going to be more than 8 plus 2 plus 2, and most of it would have already been covered in these years. Everybody needs to make a determination of what the indemnity claims or what are the indemnity factors they need to keep into place in their accounts. From that perspective, what do you think?
So I think, let me answer it slightly differently, because I don't think once the deal is struck, people are going to renegotiate. But what does tend to happen is that in situations where, from a seller's standpoint, one of the arguments that you can put in terms of trying to bifurcate the limitation period into multiple different periods. To say that if there is a situation where there has been, let's say, a scrutiny assessment, which results in a no tax demand, I do want to have a situation where the indemnity falls away at that point in time and does not continue for the remaining tenure which it is valid. So those are permutations which I have seen where people do try and negotiate, and that effectively happens in situations where, because ultimately the issue here is more than anything else is that even a seller does want to obviously have a cap in terms of till what point in time, if it's a private equity fund, for example, if they've created provisions so they can't distribute against that, or if they can't wind up the fund. So you do see situations where people do negotiate that if there has been a successful assessment where all the documents have been scrutinized, let the indemnity fall away at that point in time, rather than continuing for the remaining duration. Obviously, the caveat here I would add is that as a buyer, the risk which I'm always going to, the risk overhang which is always going to be there is the fact that there can be reassessment proceedings which can be initiated. But ultimately, as I said, something like this is you can structure it sometimes in order to get the deal through more than anything else.
Sure. Thanks, Rajesh. I think we'll move to the next part of our discussion, which is basically some other considerations on negotiation of tax indemnities. Now, Parul, when does a claim arise? What are the types of representation that should be taken? Legal reps, factual reps? What is your take on this?
Yeah, sure. So what we've really seen is that, and specifically on this legal rep and factual rep, a representation is always going to be a factual rep. Because if it's a legal rep, and that's what, if someone is giving some warranty or a representation, they're talking about their facts. And usually, a rep like, generally while, a rep is given that the person does not have a permanent establishment in India or a POEM in India, that's a legal rep and people do take it. But mostly also what we have seen is that specifically for tax insurance, we are more comfortable when we are talking about a factual rep. The reason is that a legal rep is also always a question of an opinion. It's not really a representation, whereas a factual representation is something which is a matter of fact. And so therefore you're kind of like, stamping a document and saying, this is what I'm saying is true. And if a legal rep is found to be untrue, you can always say, according to me, it was not really untrue. That's a tax authority's opinion versus my opinion. So documents should always have factual reps as well. Specifically, talking about all the factors which result in a permanent establishment or a POEM in India. Having said that, we've seen people, put in a mix of everything just to, be on the safe side or for whatever reason. The claim usually arises, when do you really get to know that there's a breach of tax warranty? You get to know only when there's a notice that is issued by a tax authority. And tax authority will, they will first issue a notice. They may not really straight away issue a tax demand order. And the breach actually occurs only when a tax demand order is issued, which justifies that, there has been a breach of a warranty. Even in that case, whether there is a breach of a warranty or not, that's again, a big question mark, because if there is a breach of a warranty, then, the indemnity should not arise. But if there is no breach of the warranty, but despite the breach of the warranty, tax authorities have found taxes to be due, then, the insurance or the indemnity will really kick in. So, but what really happens from a procedural perspective, and I won't go into, a lot of procedural bit, but when the notice is issued, then in that case, at least if it's within the notice period or the claim period, which is mentioned in the document, then the entire proceedings start, and the the person who's giving the indemnity or the insurance company, they usually take over and they, they look at everything with a close eye and, with the closed this thing. And then they will also look at, they will also make interim payments or advance payments to the tax authorities, subject to a provision that, if the demand doesn't fructify, then they will be eligible for a refund.
Sure. Thanks, Parul. So I think in my experience also, I have seen that nobody would actually go suo moto and check, whether there has been a breach of a tax warranty. Only once there is a tax demand would all of this be really opened up and checked as to was there a real breach. But moving on very quickly to our next question, and perhaps a number of questions also that we have received from our listeners, is from a P exit perspective, how do the funds provide indemnity? And I know there is not a 100% clear answer to this question, so I'll go first to Parul and then to you, Rajesh, as to what have you guys seen in terms of P funds exiting?
Yeah, sure. Thanks, Ashish. So for PE funds, I think the question also arises at what stage of the life the fund is. Now, of course, if you're talking about the 7-year period, then and considering that mostly the exits will start happening towards the, after the investment period, which is usually after 3 or 4 years, you may not typically have the 7-year period left. And many times the funds do provide, they have a flexibility for extending their term of the fund, and to the last, +2 kind of a model. And we have also seen that buyers get comfortable that, the fund will exist for a period of so many years. Then even within after that time, there will be some time which will be taken for the fund to be wound up. But I think the relevant question there that exists is that even if the fund exists, will the fund really have funds in order to meet its indemnity obligations? Now, every fund, typically would have clawback, or, they'll have agreements with their LPs for return of the distributions. And that's a very common, a very common clause in most of the fund documents, where if any distribution has been made to the investors, but ultimately tax has been found to be due, then they have a right to, claim the distributions back. Typically how that works, and, we've not really seen many times where something like this has really happened. But from a buyer's perspective, of course, the buyer will need to feel comfortable that due to these clauses and due to a back-to-back kind of an indemnity, which the general partner will have with the LPs, they'll need to feel comfortable with that. I have not really seen GPs really going out of their way and giving indemnities on their own, because ultimately that's the that's a distribution which has been made to the LPs.
Sure. Thanks, Parul. Rajesh, your take on this?
I think I'll make 2 or 3 different points, right? The first one is that the whole concept of GP indemnity, I think I don't even sometimes understand why that concept has even been discussed, purely because a GP is nothing but ultimately a service provider. So while I know that there's been a lot of discussion and people have sometimes asked for it, I definitely would look at it as a egregious ask more than anything else, because ultimately the GP is only earning his carry and service fees in respect of the investment. So I would generally stay away from any kind of GP obligations or GP indemnity which is there. The second part is that from private equity fund, just adding to what Parul said, usually you try to tailor your if I'm on the sell side as a private equity fund, you would generally try to tailor or limit your the indemnity to the tenure. And when I say tenure, it will include the potential extension plus give back period. We have even seen situations where we have said that yes, it is till the end of the life. In case the fund life gets extended by the 1+1 concept, which is usually there, then the indemnity also gets extended. So those are sort of permutations and combinations that we try and work with. And obviously, if there are certain give back obligations which are there, then you try to work within that also. because obviously what you don't want to be in a situation is that that there is an obligation to pay and you do not have the mechanism to pay. I think that's something which is always a bit of a concern from any PE fund standpoint, especially on the sell side. The other thing which we've also seen is where if a private equity fund has actually given, let's say, indemnities which goes beyond the life of the fund, or and it does want to wind up, we've seen them go and take insurance at that point in time. So not at the point in time when the transaction has happened, but maybe 2 years or 3 years later, when they actually want to wind down the fund. So that's again, there are different products in the market. Some of them have tried to do what we call an end of the life, end of the fund life insurance product. Others have tried to say that if it's specifically on the tax, try to get a tax insurance. Obviously, the premiums also reduce at that point. So that is also one alternative, which private equity funds sometimes do.
I think, Ashish, I'll just make 2 points here. One is that we've also seen that considering that if the fund is towards the end of its life and it has been filing its income tax returns in India, assuming, because a foreign fund should technically be filing its income tax returns in India, even though there's a tax exemption in India, and there has been exits in the past few years. If specifically a fund has already gone through a level of tax assessment and it has come out successful, that's also one way in which a buyer feels comfortable and accepts a shorter period of indemnity. But on the flip side, I've also seen a case where, because of this issue, the buyer actually gave a go or a no-go kind of a situation to the fund, saying that either they need to get a nil withholding tax certificate from the tax authorities, or the deal will not go through. So I think just like Rajesh mentioned, really depends on the deal mechanics.
Sure. So I think we are almost out of time, but I think considering the discussion that we are having, we'll go on for another 5 quick minutes. I think next point that I'd like to discuss with Rajesh is basically on the control of proceedings and how and what we should keep in mind while we are negotiating and drafting these documents. Rajesh, over to you.
I think when it comes to control of proceedings, usually as a person who's actually providing an indemnity, I would expect to take control of the proceedings. While in most documents you may have provisions which say that, yes, let the seller take the control, but then if the seller does not take control, it moves back to the buyer. So you have those kind of permutations and combinations. But for me, I think very quickly, the starting point always has to be that the seller takes control of proceedings. But I'll tell you where it starts getting a bit more complicated. It gets complicated in 2 different scenarios. The first scenario is that if there are, let's say, business tax warranties which are provided, because we are not only talking about the indemnity in relation to capital gains tax on sale of shares, but usually, for example, if there's a control deal and you're selling the company, and you're actually, as a seller, you're giving warranties in respect of operations of the company, which also extends to the business tax warranties. In those kind of situations, I would always want to be a bit careful in terms of how the control of proceedings is sort of handled, and the reason for that is actually very simple, because most of these issues become multi-year issues. So I don't want a situation as sitting on a buy side where the seller, while taking control or defense of the proceeding, affects me for my future years. So I do want to be always slightly careful in terms of, on business tax warranties, what kind of control do you actually want to give the seller? Or at least what you do want to do is that even if you do give the seller the control, you want to ensure that the buyer has the right to participate and approve in terms of how the proceedings are actually managed. It may be a bit more than the conventional situation where we would say that, okay, the buyer can participate but not really have the, let's say, any kind of authority in terms of signing off on all submissions and everything. Whereas in situations where it relates to business tax warranty, I would always want to be a bit more prudent, because the impact that it can have can be a multi-year impact. I think the second part of it, which actually also becomes important, is that if there are any kind of criminal proceedings, because unfortunately our Income Tax Act have had so many different criminal sanctions now. So it does actually become important that that if there is a potential breach of a tax warranty, which can result in a criminal proceeding, as a buyer, I may not necessarily want to have the seller take complete control, because again, a criminal sanction has a different implication as a buyer, leading to reputation and other aspects. So I would be very, very careful when it comes to criminal sanctions. I think that those are really the how I would generally approach what you would call control of proceedings, both from a seller and buyer standpoint.
Sure. Thanks, Rajesh. Parul, very quickly, since you spoke about some 197s also, there was a Bombay High Court case of IndoStar, where 197 was also issued and the High Court made some remarks. Do you want to quickly get into those facts and what happened there?
Yeah, I think, this this IndoStar ruling that you referred to, that's quite an important ruling. And, I'll just give a quick summary in 30 seconds. There was, a certificate for nil withholding tax that was applied for, and it was a Mauritius transaction. And what the tax authorities did, that they issued an order requiring the taxpayer to deduct tax at, little less than 8% on the entire amount. And they just held that the entire transaction was not genuine and it was a colorable device. Now, the tax authorities actually went beyond their scope, and they started looking into the merits of the case, and that too, they probably did not even apply their mind to this. But the Bombay High Court subsequently, they settled the proceedings under Section 197 and said that, you really can't decide the taxability of the receipts in the hands of the payee. And the certificate was, which was granted to the taxpayer, this can still be contested in the normal proceedings of the Income Tax Act. So I think what's important about this is that even if one does get a lower withholding tax certificate, it does not mean that there is finality to the income tax proceedings. And while it may protect the buyer, but from a seller perspective, doesn't really mean that there cannot be any tax in the future. I think what was also important is that, this whole aspect of security. And in that case, the court actually directed the taxpayer to maintain shareholding in the Indian company equivalent to 200% of the disputed tax amount of security. And they also laid down the time limit within which this needs to be kept. They looked at, what's the last date within which the assessment proceedings need to be completed. And they also had to inform tax authorities if their shareholding value dropped below 125% of the disputed tax amount. So I think it's kind of setting a new benchmark to how tax authorities are really looking at it and how the courts are looking at this entire issue. But one thing is for sure that, just because you get a 197 certificate does not really mean that this is a final certificate or it's an end to, to the tax dispute with respect to that transaction.
Right. Thanks, Parul. I think that's a very valid point, that 197 should not be taken as the finality. They could be challenged. Your assessment is still going to happen at the end of the year, which should be really thought through before you think about saying that 197 is going to be my final assessment. Anyway, we'll quickly move on to a couple of questions. Rajesh, the first question to you that we have received, I think a couple of them here, with respect to holdback arrangements, and do you think a holdback arrangement can be an alternative to an indemnity?
So again, a holdback arrangement, I did go over this slightly. A holdback arrangement, again, there are certain restrictions if you're dealing with Indian parties in terms of restrictions under FEMA. from the 18 months and the 25% cap. And that's the reason why it primarily doesn't work that well. But on global deals, obviously it can work better. But we'll always struggle on the time limitation, right? Because how long can you have the holdback? Because each time you're actually doing a holdback, you're affecting the IRR for a demand which may never crystallize, right? So that always becomes a bit of a issue. But a holdback does work when when you're in the middle of proceedings and an order is expected within a certain amount of time. So where you're effectively saying that that depending on if there is a demand which is payable consequent to the order, that will be paid from the holdback amount, or where you have a holdback or an escrow for that matter, for a wider set of indemnities for a particular period of time within that 18 months, and with the indemnity continuing thereafter. So again, unfortunately, in the Indian context, it works in a limited set of situations and not every time. But as I said, in global deals, it's a lot more.
Sure. Thanks, Rajesh. Parul, next question. I think we've got a question on that also with respect to 281 certificates and their relevance in tax indemnities. And do you think that they are absolutely material to? Do you think that we absolutely material to have them, or we can do without them?
Yeah, so I think Ashish, 281s are becoming very important in tax indemnity negotiations. Just very simply putting it, 281 has nothing to do with the current transaction. So if there is a sale of shares of an Indian company and there is a foreign person that's selling shares of the Indian company, the 281 is not really linked to that transaction, but the 281 is linked to any tax proceedings that may be going on against the buyer, in this case. And usually there is, many times, people get comfortable with taking just a 281 certificate stating that there are no proceedings which are going on against the seller, and the buyers get comfortable with that. But many times, in the indemnity, they do look at, a strong indemnity for 281. And also, they also look at the screenshots of, the tax filing returns, etc., to see if there are any ongoing proceedings which are going on. So, in a nutshell, 281 is a very integral part of the entire tax indemnity, and that usually gets negotiated at the time the deal is happening.
Sure. Thanks, Parul. I think we are out of time for today's discussion. And I think we could still go on for a couple more hours, but I think we'll stop there. Thank you both, Rajesh and Parul. Thank you, everybody, for listening.